Hello, everyone. I really appreciate you joining in. This is Tyler Bryden. I'm back with another little conversation, one that I'm very excited about. Mina Fung here. I'm going to let her introduce herself, but I'll tell the quick backstory, which is maybe somewhat fascinating to people who tune in and watch or listen to this. We actually met Mina, if you remember, through Acquire. .com. And so
Yes.
Mina is an investor. I'll let her talk a little bit more about that. But for anyone who doesn't know what acquire.com is, you can basically list your company on there. And it's almost like a matchmaking service for if you're a company and if you're potential investors who are looking at mostly, it seems like acquiring the company. It does seem like operators, but there's also apparently some relationships on acquire.com where someone lists the company and instead of it being an acquisition, it turns into an investment or an acqui-hire or something like that. And so I'm a big believer in marketplaces. Put yourself out there. You might meet some good people. And here we are today, Mina and I, through that little connection, talking on a call. So thank you very much for doing this, and would love a little introduction about you and your journey and how you ended up here talking to me today.
Thank you for having me. I run a firm called Virtual Film Pilot. So in a simple word, we run a firm that's like the financial co-pilots and growth co-pilots for startup founders, mainly SaaS, and their startups from pre-seed to exit, as in this case, we met through acquire.com. The reason I was on Acquire at the time was I was helping a client to go through acquisition, and he didn't actually ending up listing there, but then we did the process to help him exit to a private equity firm in our industry. So keep it simple, other than my small team support me in the background doing anything I need them to do. Usually in conversations or negotiations, there's just me and the founder, two of us, versus a big team of like multi-billion-dollar people.
Oh, wow.
They will usually bring 30, 40 people, all professionals, lawyer up. And then we're having so much fun to just two versus usually 30, 40. And then not until the end when we're getting after the letter of intent to get serious about buying, then we'll bring in the lawyer and the tax accountant. If they are in the States, we'll bring in the international tax people to make sure everything's covered. But otherwise, if they're in Canada, I'm located in Canada, then our firm can also take care of the tax part. And through our work with my clients and many people also as angel investors, many founders came to me, or I approached many founders as an angel investor before. And also I had 4X founders myself. I've learned so many painful lessons and delightful lessons, both through myself and other founders. So that made me realize something I need to advocate for is founder wealth. And that's how I propose to you to talk about this topic, because most people I talk to, they are thinking about survival. They are not thinking about founder wealth. The clients I work with, they have exits, they have money. They're worried about the wealth part. So that's a huge gap. Then in this world, we need to invest in preparation, not prediction. No one can predict the world. Like for example, the OpenAI saga. Who could predict that?
Yeah.
No one. From day to day, hour to hour, everything is like throw us off upside down. Preparation. Let's talk about founder wealth. And thank you for having me.
Yeah, of course. And you've got, so virtual fin pilot. It's funny. Everywhere we go, we turn and we see this term co-pilot, Microsoft co-pilot. It's really becoming this sort of tool for augmented intelligence and operation, often looking through a technical lens, but you've put an interesting spin on it, which is actually helping founders and helping companies go through acquisition or exit components. So super fascinating. Love to hear that. Lots of things that I could go for in terms of this conversation and founder wealth, but I'd love to start maybe in the earlier stages, because when people start companies, they think maybe about the grandiose exit or acquisition that nets them all this money. But the truth is that a lot of startups fail. They don't actually make it. And that's a tough reality that generally most of us, when we start a company, we don't necessarily think that we're going to fail, or at least we don't hope. And when you don't have that plan for failure, you're then maybe not doing the preparation that you talked about, or the thought about how do I protect my own wealth, my own capital when I start that business. The other last part I'll add to this, maybe there's a nuance to it. There seems to be a very different range of founder profiles. And generally, it seems that a lot of the times when people aren't necessarily thinking about wealth, it's when they're younger and when they're earlier. You're hungry, you're ambitious, you've got a startup, you're about to launch that startup. It doesn't really matter if you're not making any money. You're surviving off noodles. You're just hoping to make a bit of money so that you can pay your rent and continue the business. But as you grow a little bit older, your needs transform a lot. Your desire for life transforms a lot. You meet a partner, you start wanting to have kids and planning for that. And so your priorities change a lot. I'm interested to hear from your perspective in that earlier stage, when you're maybe even thinking about starting a company, what should we be thinking about as a founder and protecting yourself and wealth and capital and all of that?
That's an excellent question, because wealth is actually best built when you're young. The younger, the better. If you can build a company when you're 5 years old, go for it. Yeah. And save up all your lemonade monies. So when you're younger, you think about saving because it's too complicated to think about capital. You might not even think what is capital. So think about if you're getting a lemonade stand, how do you put the money away? It's just thinking about how to see accumulation. So the next step, instead of thinking saving, we make saving sound very deprived, that it feels like you either save or you have a life. But actually, if you're thinking, okay, my goal is building capital because we are capitalists. It's not a perfect model, but it's the best model so far. So prove me wrong if there's any other model that can create that much innovation. But otherwise, I believe in capitalism. And maybe the soft part means I care about people, but I also care about how to use capital effectively. And the younger, the better. So before people start, think about how to accumulate your capital and how to learn fast to work for both small and big companies in your early days, maybe a year or two, and then see where do you like. Maybe you like the 9-to-5 job or the 70, 80 hours in the finance world. Maybe you like that. Who knows, right? We are not there to say everyone should go into startup, because startup is very hard. So have the expectations, startup is very hard. According to some statistics, 90% fail. That means how do you prepare to eat failure for breakfast, or prepare to pivot or stay for as long as possible? So stay young and start young. That will be what I suggest. Stay young is also a mindset too. I know a lot of people also come to me and say, oh, I wish I start earlier. Now I'm in my 40s. It's too late. It's never too late.
So you've actually been a founder. You've gone through a couple rotations of that. You said 4 times founder. And throughout that journey, I'm guessing your own perception or perspective on founder wealth and how you managed your own money changed. So can you share a little bit about from startup 1 or founding 1 to founding 4, how that sort of your mindset changed around your wealth and capital and protecting your own money as a founder? How did you have that evolution?
Coming from the corporate world, I was leading a department. I was one of the few women, or maybe the only woman sitting at the board. So I know board politics. I was also a board founders for nonprofit. So I know both. And I was working in a public company, so not the nonprofit. So you have a lot of confidence. You thought you can do anything, like including doing your own business. I led a team and I thought, oh, everything's easy. I know about business. I'm from business, so I know. But I felt miserably. I invest a lot of my own money and waste a lot of own money. The reason I advocate for founder wealth, because the money I have, I thought I have some money to waste. I'm fine. But I waste a lot that to the point that I thought opportunity cost and compounding effect how much I have lost. It's not just like hundreds of thousands that I've lost. It's I actually sold some of my Tesla share.
Yes.
to finance my startup. And then it could be, even if I use less, didn't sell as much, it could be like make me millions without me working. I could just sit around and have that much money. But that doesn't mean that people should not think about investing their own money. It's like when you invest this much, think about your opportunity, think about how not to waste, and be disciplined about it. Maybe don't take out like all your shares, don't liquidate all of it. Maybe see milestone. If you can sell this much, then you take out more to accelerate the sale or to accelerate the scale, not to just dump money in a dumb way, which is my own experience, and then hope it will work and just waste a lot of money in various things, like build a beautiful website that no one cares.
Yeah. And so maybe we can dig a little deeper into it. So you've set up a couple companies. You had come from a bit of a corporate background, so it sounded like you had saved a bit of money, and that was the seed for starting the businesses. In terms of structure, or when you started a business. So we're in Canada here. We're both in Canada. You're in Vancouver. I'm in Toronto. Not to point too specifically to where you are, but in Canada, there's an option that is pretty highly advertised for people who are thinking about starting a company. You've probably seen it, Futurepreneur and BDC. So there's a combination of a loan that they will give you. It used to be about $60,000. I took that for my first business. One of the problems for that first business, or with that loan, is there is collateral required. So you have personal liability for a loan that you are then taking out on the business. And luckily, in my case, I was able to navigate through that. I paid back that. I have no personal liabilities. And personal liability for those loans was one of the most stressful parts, especially when the business was not growing the way I thought it was. And any sort of turbulence in the business could just create more stress, because if I'm burning through cash, I know that's personally liable. And even if the business fails, I'm going to have to pay that loan off. That's going to be, that could be a year or years of effort to pay that back. So I'm just wondering, maybe I'll just ask that. When you come out to fund a business and you haven't necessarily worked in a corporate background, you don't have that seed capital. How should maybe founders think about, they have this idea, they want to do it, they want to test it, but they don't have the capital to invest, or if they do take this capital, it's going to have some personal liability or collateral on it. How do you think about someone who's in that situation? And do you have any sort of recommendations or guidance for them?
I won't say don't take any debts, but there's serious consequence, because one thing I haven't mentioned about starting young or starting anytime is every decision we make, there's compounding effect. There's compounding both ways. There's positive compounding and there's negative compounding. So whatever we need to pay back or lose is not just that, for example, 1,000, let's just make it small, imaginable. So compounding effect of 1,000 going up versus negative 1,000 going down, it's quite devastating. So I would say there's success stories about people using 6 credit cards and build a business. But yet they don't know there's 99% of them using that credit card and ruin their life.
Exactly.
So media is a good place to look for things for reference, but it's not a good place to learn it in terms of one variables. I will recommend people to sell things first. Like, for example, I want to build the next app. The reason I have the firm is I can make money faster by building a firm, serving the founders, my customers. Then I'll ask them, hey, I have this idea. For example, I want to build this app. I'm so tired of all the budgeting apps out there that's not working, all the accounting software out there that is so complicated and convoluted. And how do I build that? Like, I used to take computer science in university, but I haven't done any programming for many years. Even if I start to learn now, I'll not have the speed I need. So I also need a co-founder. So in that sense, I can first also build my services business first, many SaaS company actually go up that way, and then have money to fund ourselves. Once we get that product market fit or kind of product market testing done, then we either put in more money or ask for funding. Then you're not wasting your own time and other people's money.
Basically, lean business model and testing. If you can test the product in a very initial conceptual stage to see if it even has any traction, even if you can pre-sell that product before it's built, so that you're not investing, instead of spending the money on a fancy website and all that stuff, trying to gather some feedback directly from the market. The other point you mentioned it, which is if you can find a co-founder who has supplemental skill sets. So if you're technical, find someone who can lead that marketing and sales approach in the early stage, or if you're the marketing and sales, find someone who's technical and can build it. So either you're not paying a bunch of money for some firm to build it for you, or trying to build it yourself and crying to yourself at night when you realize you weren't meant to be a developer.
Yeah, because I've tried those both. I've tried to hire firms or programmers to build things for me. And of course, it doesn't work. By the time they build things or have time to build things, I already changed my idea, or that idea already has to be not good. Now, as an angel investor, will not invest. We invest as team, as a fund. So we will not invest in people who are hiring third party to build the software. It's not, no, it is a good business model that might work if you don't need outside investment. But investors, you don't move fast enough if you rely on other people to build it for you.
I completely agree. And with founder-led sort of development in the early stage of the businesses, there's a lot of passion and resilience required. And if you're just hiring someone on the outside party, it doesn't necessarily pan out the way that you want. Now, there's a very big disparity in types of businesses that you can build too. So I have a good friend who's built an incredible business. He took over a bakery that his dad had run for 20 years, and he's expanded that business and turned it into a bit more of a franchise model and had a great success. There's also other businesses that are maybe just small, simple Etsy stores or online e-commerce or product that are maybe more mom and pop or custom made kind of thing. And then there's more than this, but then there's what other people consider which is the startup. You're building technology, you're building software, and all of those different models of businesses, or the kind of models that you're trying to create, the businesses you're trying to create, require different needs and different things. One of the things that is interesting with startups and technology is generally some people are capable of raising money before they even start building the business. Maybe they've got some history or some good relationships and they're able to pull some capital together. But in a lot of cases, that might not be true. And so I'm wondering, when we're going and looking at those technology businesses, there's this interesting perspective on how founders should think about paying themselves. And I'm interested to hear your perspective, both from you have been a founder, and then you've also been an investor. Say you are a founder of a company, you've got a little bit of traction, maybe a little bit of revenue, maybe you raise a small pre-seed or some family and friends. What do you see as the pathways that people pay themselves? Maybe you can give some specific figures or ranges. And what are those ranges that you see as appropriate versus also how an investor views that if they were looking at the financials of a company? I'd love to hear your perspective as someone who's been on both sides of that equation.
Yeah. Also, a lot of people come to me and say, all my friends, they got funding before they even have a product or things. I'm like, good for them. Then go ask them, how do they do it? I don't see that as an investor. In those kind of case, we all have a bit of intuition and checklist to go through where fact. Like if they have previous success, of course, we'll listen. And then if they have a big network, we'll listen. And if they know how to operate, or their former operators, they help. For example, they sell, if there's no fixed salesperson, and they build their sales team from 18 months from like 0 to like $1 billion revenue, like definitely will fund you, definitely, right? Because sales is the number one thing, then you can pivot your product. So It's hard to say it will not happen, but the percentage of it, if you actually ask anyone, is close to nothing, especially to Canada, unless you have personal relationship with that person. A lot of people actually hide their relationship with certain investors or their family network. So it makes it is all them who get the money, but it's not that simple. Sometimes maybe it is. So who knows? But for people who cannot, they can try. It's never a bad thing to try. But then if you try a few times and then you realize people are not even giving you the time, then you will know that maybe there's other path. Try a few paths. And in terms of paying yourself, I would say pay as little as possible. But then, of course, even one-man now, we're talking about one-man profit. Surprisingly, even one-man in Canada, I'm not sure. Maybe in the States, I was just in San Francisco. Even one-man is $20, $25.
Yeah.
If you're in Canada, 25 Canadian dollars. If you're in the States, $20, $30, the US dollars. Forget about the exchange rate because each country has their own earning potential. So just assume it's the same price. It's expensive. We need to make a living. So number one thing is try to sell things, make enough so you can eat to keep going. A lot of failure comes from lack of cash or won't be able to sustain. So make cash, build the capital, and then be persistent and determined to tough it up. There's always up and downs.
So I've had a very interesting experience through, I talked to you about it a little bit earlier, which is like when I started the first company, a relatively young, desperate, ambitious person, didn't really care how much I paid myself. And so the first few years I was relatively paying myself nothing, enough to get by, luckily, which is, like you said, pay yourself as little as much and you hope that you can sustain. I find that there's a very interesting mindset that takes place. And I'm interested to hear your thoughts on this when you're not paying yourself much. And then now I'm paying myself more and I'm much happier. So that's one thing I've experienced. The more I've paid myself, the more I'm happier. But at the same time, it can be the golden handcuffs that also make you comfortable as you pay yourselves more. There is this sense of desperation when you're not paying yourself because you know you need to engineer yourself out of that situation. And with that becomes a super intense focus on building a business or at least raising the money. Whereas as you start to pay yourself a little more, you start to get comfortable. And so it takes a very self-motivated, ambitious person to keep that pace up, to keep that desperation up and act like you're in a sort of desperate state every day to continue pushing the business forward with such speed and force. I'm not sure if you have any thoughts or your perspective on even your experiences as you've gone through of paying yourself little and having that hunger and that drive and engineering yourself out of that situation versus as you pay yourself more, having to maintain that drive and motivation.
Mm-hmm. That's what I do with founders that's making money or they exceed with so much money. Usually I will ask them, what do you want? Surprisingly, these founders, they're so focused on building the business. They love business. So they're thinking about multiplying the capital, growing the capital. I said, how much do you need? We have a lot of room, even within the tax. You can optimize, you can pay yourself a little bit more. And they usually say, I don't need more. I just like to see my capital grow. I just like to build business. Even when we invest in business, it's not speculation, it's business. We talk about business. That's the best part of my job. We talk about business, even when we invest in the public market. For example, when we talk about NVIDIA, that was like 18, 12 months before it went, like we bought that in, we're like, why we like this? Why is a good business to invest? How much will stay with it? And they said align with our investment thesis. And then if it's good, the founder will make the final decision. Actually, disclaimer here, what we're talking about in terms of any investment is for entertainment purposes. So don't take my word. And and that's how we decide, what do you feel better if you invest in NVIDIA and see how crazy it grows? You are part of the capital and part of the the shareholder that build the business, or you pay yourself so you can fly first class. The clients I work with, they can fly first class, but every time they're like, maybe I'll do business next time. And they always ending up flying economy. So it's their choice. They can choose to do business. First, they think it's waste of money, but then they ending up. So for them, it's you cover your basic, depending on how basic you feel. Then above that, you're thinking what will make you happy. Do you want to be effective? Do you want to invest in business so you feel good? Or do you want to have a little bit comfort, like treat yourself once in a while here and there? So it depends. Depends on how founders choose to live their life. If they want to be a bit more comfortable, if they have kids, for sure they send their kids to private schools. So those things are non-negotiable. Then that's not about, oh, do I pay myself as need to? Then they will pay themselves enough to send their kids to private school. That's their preference. But otherwise, most of them live very moderate, disciplined lifestyle.
And you touched on something, which is they want to see sort of capital grow. And I guess there's multiple ways to think about that. But say you're a founder, you're not taking a big salary because you're reinvesting any earnings through the business back into the business to see it continue to grow. And in general cases, when you're making that investment, you know that you're trying to build somewhat of a sustainable, maybe profitable business, or you're trying to invest in compound growth to make yourself a viable or favorable possible acquisition or acqui-hire or private equity transaction where you can exit out of the business and compound your wealth in a more nominal way. However, then there is this risk with any business. The macro environment can change, the world can change, competitors can emerge that start to erode your growth. And so while founders are optimizing for that ideal outcome, I guess the question becomes, and in the end, in a lot of stories, you talk about it, like the 6 credit cards. You take out the 6 credit cards, and we see these winning stories. But there's a lot of founders who didn't pay themselves. They worked on a business for 5 years, and then they didn't get the exit. They didn't get the acquisition. And so they've left after 5 years. What do they have to show? Hopefully they built a good relationship and some networks, and they can move into a job that's fairly well paid. And hopefully they don't have big debt obligations and things like that. The question that I'm trying to get to is that balance, that risk profile. How do we hone in and define that even further? And I guess people have different perspectives on this, but how do you figure out what is that proper bandwidth? And you talked about pay yourself as little as possible, but then especially founders, their risk profile or their intelligence level is allowing them to make this risk assessment and say, hey, I have 80% chance or 50% chance, and that should then change the equation of how much they pay themselves or how they should be thinking about the future or how much money they take out of the business to pay themselves in case that it doesn't work out. And this also changes is, have you took investor money? And so you have responsibilities to investment. An investor gives you $250,000. Most likely they don't want you paying yourself a $250,000 salary next year. So I know I've asked, that was a lot of points and not even a direct question, but any thoughts around that risk profile and how you hone in on what is the optimum? Are there benchmarks in businesses that founders should be looking at based on certain stages? Or how do you recommend founders pay themselves beyond just pay yourself the basic, et cetera, et cetera?
I don't usually like to use the word benchmark because in our industry, everything's benchmarking the hell out of it. And everyone's like not going anywhere with that. So I will say it's not benchmarking. Invest in preparation means that you have your basic cover. Early on, you have a little bit of capital you put away that will also make money on you. So you have your own money. And if you don't have any other income coming in, then you have to pay yourself a little bit to live on. And then you have to decide between the risk you take and yourself, how much are you willing to bet? Because for ventures, if you get funding for ventures, you're just one of their 100 as angel investors, or you are one of their 7,000. Those big VCs, like the 7,000 one, they have power law on their side. They will hit quite a bit of unicorns and make thousands of returns. But for you, you have one bet, two bet. Are you risking everything? So then between that, you have to see what's the trade-off. So cover your basic is important. That's why I advocate for founder wealth. Is cover your basic. Make sure you have signed on your insurance earlier. So anything happen to you,
Yeah.
you have your insurance cover. The younger, the better. Also have money put away as contingency. So after all those things, then every day it's new. No one can predict what's going on. Every day, everything is alive. If it's too steady, then you're not alive. It's like too
Yeah.
much going on. You have no basic, then you are stressed yourself out too much. So at the end, when people stress out too much, they will ending up being heartbreaking and financially broke.
Yeah.
So that's not what I call building founder wealth.
Not an ideal situation.
Yeah, not the ideal situation.
And you talked about opportunity cost too, which is a super fascinating, just mental concept that we wrestle with as people. You talked about, for example, you took some money out of Tesla stock, which then that Tesla stock continued to grow in value. And instead of hustling and working hard, you could have just saw that money stay in that stock and continue to rise. And that's a tough lesson. For the lesson that I had, the one that I struggle with still to this day, was when I was first starting the business in 2015. I was wanting to buy a house. And I had a little bit of money saved up to the point I could pay a down payment. But because I didn't have this financial history built up or 2 years of good cash shown in the business, I was getting laughed out of banks. They would laugh at me for trying to get approved for a home. And I got a house last year. The market has changed a lot. I bought not at the top, thankfully, but pretty high up. And so one of the opportunity costs for me beyond just taking salaries at other companies that could have paid higher was that I didn't get to buy a house in 2013 or 15 when the price of that house was very low and could have compounded greatly versus when I bought it now. And there's these unforeseen trade-offs that you're making when you're taking that journey that can really be a tough thing to wrestle with as you go through. So that's yours was maybe the Tesla stock, mine was the house purchase. Are there any other sort of opportunity costs that you think founders should be thinking about if they're deciding to build a business or start a business?
House, that's especially in the Canadian market, that's tough. But at the same time, also think about with all your failures or my failure, the things we also learn from other people. It's those learning that is priceless. We're still doing okay now, but we could be better, right? But those learning, you cannot learn it from books or from those people who sell the courses online and say, I can teach you to make money. Crypto actually is, I love the technology. I believe in it, but it's just too many scams.
Yeah.
I don't even like to touch it. It's a hotbed for scammers, basically. So opportunity, think about what you learn as a gain, what you pay if you have to gain that kind of knowledge. So there's a baseline also for how to protect ourselves, also a baseline how much we pay for learning and how much we grow. And other opportunity is think about there's things within our control. There's things outside of our control. And when we build, for example, preparation, we always emphasize on invest in preparation. When we build financial models for the clients, as the co-pilot model, our co-pilot is either as their virtual CFO or the family office. So both ways we build, for example, financial model, but we are not predicting anything. The only thing I said, this is not a prediction. No one, except people who can tell you they have like fancy models, no one can predict, like including AI. Like OpenAI, they cannot predict the black swan things. So if they cannot predict, who can say we can predict? No one, basically. Then how do you do the financial model as a preparation and cover your basis and go from there? And for example, if we make investment mistakes or we sell a company too early or we invest in a company too late, then you look back at your decision making. If we make anything wrong, if you're like, no, then that's thing outside of your control, be happy with it.
You talked about something interesting. I've got lots of questions. I'm also going to value your time and I'm not going to abuse you too much with these questions. But one of these interesting parallels or statements around being a founder or being an entrepreneur or running a startup or being even in an early stage startup is that you have accelerated learning. And so it's not necessarily capital accumulation that you're doing, but you're accumulating knowledge and wisdom, ideally very quickly through painful lessons that come from being, more responsible in, say, a startup. However, one of the opportunity costs that I think about is when you're a startup and maybe you don't have the capital fundraising capabilities to be able to, for example, hire the best people in the world. And so you're maybe stuck, maybe you're offshoring. And again, no judgment on that statement, but you're maybe not surrounding yourself in person with maybe the world-class talent that you want to work with. And so I just would be interested to hear your perspective on this. Hey, I'm a startup founder. I'm going to learn a lot of lessons very quickly, but there's also a lot of lessons learning from embedding yourself into a large organization with some of the very talented people. We brought up OpenAI. The talent pool at OpenAI, we saw the recruitment war over them when it seemed like things were in shambles. And from my perspective, there's a lot of accumulated lessons from being a founder, but there's a lot of accumulated lessons that from seeing people who are that intelligent and smart working every single day. So how do you think about that trade-off of accelerated learning in the startup environment versus accelerated learning in working with some of the best people in the world and maybe a larger or further along company with more capital?
Mm-hmm. So that's why early on, especially when people in their teens maybe start working when you're in your high school, not sure who will hire you, but then start early and then learn from the bigger company. And also it's good to learn about politics in our whole economic night now when we're doing family office investment, thinking, projecting 20, 30 years ahead. Of course, no one can think about that, but we're thinking of past performance doesn't reflect futures returns. Then we're thinking, is there enough population growth to support the continued growth? For example, when do we stop to invest in NVIDIA, for example? We stop as soon as it go up like to that kind of crazy, way beyond the baseline we're interested. Then you're thinking, then who can support that? Do they have that kind of growth? Do we have population growth? Where's the region you want to think about those kind of things? So in the beginning, for example, we help people from PC to exit. But in the beginning, it is good to hire people that you can afford. Sometimes you'll be surprised some of those people can be very smart too. They will be very green, but constantly trade off if you need a lot of time to train people.
Yes.
Myself included, is it worth your time? Is it better? Can you afford someone better? So those are constant, almost month to month, if your fast growth, week to week kind of adjustment. Maybe a combination of both. But in the beginning, there's also another way to do it is, for example, I said co-founders. You can bring people in, have a co-founder start with like 1%, 2%. So if they start a few years, the company meet a certain milestone, they hit the 10%, for example. And then when you're 10% and growing fast enough, hit the product market fit, then you both go out to raise for funds. So you now have better chance of getting funding because now you have two founders. And also when we invest in co-founders, we have to see if the other founder is 1%, that doesn't mean anything. It has to be at least 10% to have skin in the game. That's another way to think about getting the people in, sell your vision. If you can sell your vision to a co-founder, maybe it's not easy to sell the product.
Yeah, or to investors. If you can't sell a co-founder or highly talented people to come into the business, you're probably going to have some future challenges. Now we're both sitting in Canada right now. You spent some time in the US. One of the, I would say, luxuries of building specific sets of businesses in Canada, again, my experiences is technology. There's opportunities for non-dilutive types of funding. One of the big ones, NRC IRAP, it will fund a project for you to develop. And as a lot of a set of capital, say $100,000, generally it maybe starts 25,000. They'll scale up based on how you achieved. And you, as you're doing R&D work at the end of the month, you can submit payroll for who was doing the R&D work, and they will actually deposit that money back in your account. And so if you're lucky enough to build a relationship with an NRC IRAP advisor and make it through their checkpoints, it can be a great source of non-dilutive capital that helps you decrease risk in the business, grow the business without diluting it, and also even maybe paying yourself a little bit along the way. The other big program is SHRED, which is a tax credit that if you're building, you can get some money back at the end of the year. Any perspective on those programs or any other ones that you think anyone watching this who is maybe building their own business should be aware of?
I'm not familiar with SHRED or IWAP. Maybe, mind you, many successful business might be building up from there. From my perspective, the people I've come across with, they spend so much time. Here's another thing about opportunity cost. If you can grow fast enough, do you use your time to build a business, or do you use the time to do these grants? This is not free. It sounds like it's free. It's not free. Your time is there. Your attention is there. Your focus is there. So people have another trade-off. Right. Plus, then you're thinking what market, if you're selling to the US or you're selling to different countries, what kind of criteria you have to meet. I'm sure I know a company that's selling to Africa, they still get check claims. But then that's interesting to see, is it you're supporting Canadian building Canadian business, or you're supporting Canadian building business benefiting other country? Not sure. I'm not familiar with that area, but people have to choose what to focus on, how to grow it. Is it worthwhile their time? And time is actually another factor that we haven't talked about in founder wealth. A lot of founders focus on this kind of area, not that I don't want to touch it, but is if they focus on it and then at the end they're not going anywhere. When they're focused, the first two things is cash flow and sales. If you focus too much of getting this kind of thing, are you building things to get the loan or the grant that you just survive? And then forget about, are you actually building a product to solve any problem? So the focus shifts a little bit. And then 5 years later, if that doesn't work out, did you gain anything other than all the paperwork? Even if digital now, you have to ask, did you learn anything new about the customer, your industry, or the problem you want to solve? Maybe, but the people I work with, they haven't, at least so far, they haven't looked into those kind of things. And they're doing really well with the time and capital they have, and not needing those grants, loans, because everything has a cost associated with it.
Yeah, and it's interesting. You talked about what are you optimizing for, and we have seen a little bit of a shift in the environment where at one point it was growth over everything. Drive growth, whether it's profitable or not, because at some point you can turn some levers on and turn on that revenue generating cash making machine. And in some cases, those have panned out beautifully, and they were able to turn those revenue mechanisms on, and it worked. In a lot of cases, companies start to, or have the risk of burying themselves in an unprofitable business operation where then they can't figure out how to turn those levers on in the right way. And so they churn through or burn through a customer base that was loving their platform when it was free. And as soon as they start to ask for a couple dollars or something, it starts to be not as favorable. They don't enjoy the product as much. Now, we have, I feel like, done a good job dissuading people, or at least educating people about the possible risks of starting a business and how you should be thinking about founder wealth. The part that you've actually had some experience on, we're moving towards more of the ideal or more end state, which is, okay, you're actually starting to bundle the business up for an acquisition or a private equity investment or some sort of acqui-hire. Any thoughts about, if you feel like you're in that stage and you have a viable business and one of those paths is available to you, what should a founder be thinking about then? And then the follow-up, I'll let you, for sake of time, maybe push forward to that. What happens after an acquisition and then the money comes because there's taxes, there's capital gains, there's other things to think about. People think you ride into the sunset once an exit happens. A lot of people have earnouts. A lot of people have lots of complexities to get the money that they're looking for. So further down the journey, from your perspective, from what you've seen about how founders should be thinking about wealth.
Actually, even when founders start building either as their family office or as their virtual CFO, I constantly remind them where they are at. Like this business, you're looking, it's not just on the book, you're building this much. If you exit today, how much are you thinking your wealth? Pretty much I have a wealth snapshot with them, thinking about, okay, you're not just building this cash flow, you're building this much asset and capital. And then by the time they're there, they pretty much prepare to go. Of course, I'll give a range because on a bad term, it can be a multiples difference. I'll say, if, for example, if it's a 10 to 30 millions, it's a big range. But at least they know they have, for example, 10 million if they hit a certain milestone. And then when you're at that stage, how do you prepare? Well, the financial has to be absolutely clean and critical, because that is one part you don't want the due diligence to go into that. Whip up everything, is waste your energy, waste your stress and time. So prepare everything to be clean, prepare all the documentation, the backgrounds to be clean, all the IPs are signed. Let me backtrack a little bit about IP. Now we're talking about exit. But in the beginning, I also seen one of the failure of so many founders I've seen is wasting money on the IP part. IP is important, but I have helped founders exit without IP. That doesn't stop them from selling. That doesn't stop them to exit. So don't think you need the IP right away and waste all the money, because before you hit the product market fit, IP is no use for anyone. Even if you have an IP, if you don't have money to enforce it, it's waste of money, waste of people's time, basically. You don't want to waste yourself time and yourself money. I'm sure other people will be happy to take your money to help you do that. But we're talking about founder wealth, yes.
It's amazing if you can make it from starting a business all the way to an acquisition or an exit or private equity transaction. And you think maybe you made it. And then there's all these other complexities that you don't think about. Generally, the purchaser putting a lot of pressure on the end of those negotiations. Or, for example, one of the horror stories is you get bought, and then there's release of cash based on certain milestones of revenue. The one story was that the company bought the product, had those milestones around revenue, and then they turned that to a freemium add-on. So it could never achieve those revenue targets. And so the founder never got the payout that they were expecting or hoping. So there's these horror stories. And I'm guessing that's where you come in and help people navigate a little bit. I don't know if you have any, we could spend hours on that. So I'm not going to push you into that. Any maybe closing thoughts on that sort of perspective? I know we only touched the surface in some cases. And then I know as time of recording, there has been this incredible sort of OpenAI saga and drama. And we were interested because we basically saw one of the better founders of a generation almost lose
80 billion.
Yeah, exactly. Through that. Any closing thoughts on that exit part there? And then happy to touch on this topic of the OpenAI saga here.
Yeah, the exit is, we don't do a case that is less than like 1 to 2 million. Now it's probably 2 million. But depending on how well I know the founder will do less than 2 million, but usually it's 2 million and up. So before that, maybe use other like acquire.com that they can do it quite effectively. And then you don't need any advisors, but here's the advisor comes in. Between 2 million, for example, you're selling to 10 to 30 millions, that's a huge range. Even if you pay us like hundreds of thousands of dollars, if we can make you 1 million more or 2 million more, that's your change. What will happen, for example, one of the founder, what happened is we make we negotiate so much more for him. Pretty much he had like us for free because the more he got. And then he has more to pay us. We are the lead advisor and also the lawyer, the tax accounting, everyone, and still has changed back.
Yeah.
And we protect every angle we can see. As a lead advisor, we cover everything. We look at every line with the lawyer and challenge even how the lawyer thinks. So don't think that you're paying someone. It's an investment if you can cover all your bases.
Yeah. Make a little more after all the effort that's gone in. And then I have tuned in and out of this OpenAI drama. I'm part of an AI company. I have a lot of love for the work that they're doing. And I needed to almost tune it out because there was so much chaos there. And it seems a little bit has settled at the time of recording. Basically, almost $80 billion vanquished pretty quickly over a weekend. And it seems things are settling a little bit, but would love to hear your thoughts and perspective on that and any founders or any takeaways you have for sort of founders or how you're thinking about this after watching it all unfold.
I know those nonprofit business model works in Europe, but the laws in Europe and US or even Canada is similar to US are quite different. No one should have that absolute right to kick the founder out for, well, it could be 8,000 or 8 million versus 8 billion, but still the founders put in all the work, all the life work into it. So founders should protect themselves. But sometimes you're thinking maybe this is Sam Altman bought this in himself because he chose the board. You chose the people, you tap into the people who sit in your board. And sometimes you have certain kind of ideas, but then you can change your mind, you're founders. So I would say as much as we don't like Facebook founder, how he managed the business, but I like his structure. No one can kick him out. I'm totally pro-founder, even as an investor. So if an investor can work really well, we want the founders to be in to lead it to the billion IPO and beyond. So protect yourself as a founder, have a structure that no one can kick you out, but also be open to have advisors who can challenge your thinking. Once in a while, we can get very confident and we make mistakes. So that's the good trade-off to pay, but make sure no one can kick you out. It's your company.
Good words to hear. And you brought up Zuckerberg and the superpower that he has within it, but it's allowed him to really direct that business. And in some cases, there's been questions of if it's going in the right direction, but then in some cases, people have been very happy with how he's managed that power.
We want more founders to make good money. That's why I have the podcast called Small Fish, Big Money. You don't need to be public. You can stay small and make good money, and then everything fit into how you want to live your life and building your business. And as a soft capitalist, it's important to care about the social thing. But at the same time, building your wealth is important because with wealth, you have more say in how you want to change the world. We don't want to build to change the world, but with wealth, you have a say.
Yeah. And I'm going to put some links in the video and into the podcast episode. But if people want to connect with you, what's the best way to reach you or at least follow you in the podcast?
You can follow me on LinkedIn or on X. I'm not active there as I don't post that often, but it's a very vibrant startup community. I would say X. But in terms of connecting with people, I have my red hair there. I welcome all the connections and comments. Of course, we have lots of things to learn, and any comments good. I love the startup community.
Beautiful. Thank you so much for joining me here today. I really enjoyed this conversation. I got some more things to think about. I could ask you questions for so much longer, but maybe we'll save that for another day. Thank you, Mina, for joining, and for everyone who tuned in, watched, or listened to this. I appreciate you very much. I hope you have a wonderful rest of your day. Bye-bye.
You too. Thank you.